My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. A lot of people are friends. I'm just trying to save you some money. My job is not just to educate, but to entertain, teach, put it in context. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. On the eve of the biggest Federal Reserve meeting in ages, I come to praise Jay Powell, not bury him, unlike virtually everyone else on air. I know this market is incredibly jittery and awful, that I know he won't be able to thread the needle perfectly, but I do have faith in his decisions, and I think the second-guessing at this point is pointless and, at times, demeaning. After a day where the Dow lost 152 points, once again awful. S&P declined 0.38%. Thank you for nothing. NASDAQ actually inched up 0.18%. Go figure. I want to demonstrate that much of our latest bout of inflation simply isn't the Fed's fault. The way I see it, we had two big rounds of inflation. You can blame the first round on the Fed's inaction, too much bond buying when they should have been selling, should have taken multiple quarter-point moves when employment got so strong. These were mistakes on Powell for certain, and they've hurt us. But the second round is all about geopolitics, and it's hitting the whole world, not just America. Let's start with the most obvious, oil and gas prices. Is Jay Powell really responsible for the price at the pump? Did Jay Powell invade Ukraine? Oil's up because of the sanctions on Russia. Something like 5 million barrels have come off each day. There's tremendous oil hoarding, too. This is hitting every country in the Western world, and there's not much the Fed can do about it, but we still blame Jay. Now, American producers could close some of the shortfall by pumping more aggressively. The technology exists for us to produce 2 million additional barrels a day, which would be enough to move the needle and send your price at the pump down. But the oil companies need more pipeline capacity. Specifically, they need confidence the U.S. government will support additional infrastructure. Otherwise, they can't get enough product to market to make it worthwhile. I thought there was a chance we could see a deal between the oil companies and the White House, but Biden's got to play to his base, and his base hates the oil industry. Sure enough, just a couple days ago, when I thought things might be closer, the president decided to trash Exxon, laying all the blame for high oil prices on profiteering. Listen to this. Quote, the reason they're not drilling is they're buying back their own stock, which should be taxed, quite frankly, buying back their own stock and making no new investments, end quote. He went on to say, quote, so I always thought the Republicans are for investment. Exxon, start investing and pay your taxes, thanks, end quote. Now, I can quibble with many of the details here. For example, Exxon has expanded its drilling budget dramatically this year, albeit off a very low level. Sure, they buy back stock. They've always bought back stock. But they boosted their capital budget by 45%. It's actually up from pre-pandemic levels. And as David Faber, my colleague from Squawk the Street, who has a big Exxon special coming up on the 22nd, pointed out this very morning, they do pay all of their taxes. But the reason Biden's rhetoric frustrates me to no end is that it's totally unproductive. If he wants cheaper gas prices, he needs the oil industry's help. And he's not giving them much reason to cooperate. The real bottleneck here is a lack of refining capacity, and guess what? It's Exxon that is the only company building a new refinery in this country, for heaven's sakes. Imagine how Exxon feels. Not that we should care, I know, but I'm just saying they're doing the opposite of what Biden said. But what does Biden do? Well, he'd rather make a deal with the murderous government of Saudi Arabia, as he has called them. Not the best business partners, but maybe it's easier for him to strong-arm the Saudis. Either way, Jay Powell can't solve the war in Ukraine. He can't get more oil out of the ground. He can't make the president more friendly to the fossil fuel complex. And the same goes for the other big source of inflation, food. Normally, our farmers would have, they do pretty well meeting demand, but we got a 1-2 punch here. Ukraine is the breadbasket of Europe, responsible for 13% of the world's calories. And on top of that, the weather's not playing ball. There's a global food price, and, of course, it's going to scream higher when you take out all that capacity. In the meantime, we don't have enough staff at our slaughterhouses thanks to COVID. Poor timing all around. And, yes, there will be massive famines in Africa because of Ukraine. I hope we pay attention. Getting the food to the stores next. That requires trucking, and an amazing number of truckers have retired, which, like everything else on this list, could not be predicted. We don't have enough younger truck drivers to take their place because younger people have been told this whole field will be disrupted by autonomous driving, so why go into it? Then there's the packaging. Much of it is oil and gas based, and we know that comes down to Russia, not the Fed. What's fascinating, though, is something that James Quincy, the CEO of Coca-Cola, told me yesterday when they introduced their new Jack and Coke cans on Squawk on the Street. Aluminum sheeting's finally coming down in price, and that will allow the can makers to add capacity, which Quincy thinks will bring costs down. First guy I've heard on air saying costs are going to come down. The lack of new capacity in pretty much everything has kept prices higher than it should be. Even if the Fed had raised interest rates more aggressively, the supply side of the equation wouldn't be any better. Next is everything that goes into the home. The velocity of the work-from-home scenario was pretty shocking. Totally unforeseen. Was Powell supposed to see it? Nobody else did. Given that most of the companies we deal with in our day-to-day life didn't think we'd get a COVID vaccine so quickly, they cut back on their plans for 2021 and even 2022. They still haven't caught up. Plus, much of the capacity needed to meet all of this demand came from China. We tried to rely on our own supply chain to meet the new demand, but the ports in Southern California, the mainstay, are run by the unions, notoriously tough, and the whole situation is a mess. It's not Jay's fault that we still use that just-in-time inventory and keep very few parts on the shelves waiting to be used. So we didn't have them when we needed them. When it looked like we might have the supply chain fixed and the pandemic under control, a new version of COVID took off. And if you recall, we had no idea whether Omicron would be more or less deadly. Powell chose to wait and see. In retrospect, definitely wrong. But before you consider him obtuse, the Chinese had the same info we had and the same medicines we have. And look what they've done. They've gone into complete lockdown. How can Jay take that possibility off the table for the U.S. if the Chinese do it? We're so in love with how many great decisions the Chinese make. China's a major supplier of our semiconductors, particularly lower end, but still special chips that are now in short supply. Cars and trucks have been hurt the most because there are so many electronic parts in them. Didn't used to be. So new cars and trucks are in short supply, which then forces up the price of used cars, another key inflation component. All sorts of appliances need these chips, too. So these manufacturers can't produce as much as consumers want, and that causes prices to go up further. All right, now, in retrospect, the Fed provided way more liquidity than it needed to. It should have stopped buying bonds more than a year ago. It should have been selling bonds in size well before it started raising rates. When Powell saw what was happening, it might have occurred to him that if he could just slow everything down, we might be able to get through this without a real hard landing for the economy. After all, because of the Great Resignation, we have way too many job openings and not enough people to fill them. I think the great application era will soon be upon us. But beyond selling trillions of bonds to rein in the economy and raising rates to cool down what can be cooled, which isn't much, it's not, we got to stop blaming Powell for all things inflation. There were circumstances beyond his control in the second wave that are affecting every country on Earth. Now he has to hit us with some monster rate hikes to cool things down while selling, I hope, at least $200 billion in bonds a month, twice the current schedule, just to fix a problem not of his own making. The bottom line, it's a tough call. But Powell needs to tighten aggressively at this point, if only just to say, we mean business, whatever business that might be. Jeff in California. Jeff!
Hey, Jimmy Chill. We love you here in downtown L.A. Thanks for your hard work.
Man, you're terrific. Thank you. I used to love downtown L.A. What's happening?
Yeah, the stock I'm calling about is Roku. Strong rumors have it that Roku will actually be bought out by Netflix. And if that does happen, obviously we're looking for 20% rise or more in Roku. Also, Roku's in only about 21 countries, so it seems like there's a lot of room for growth in Europe. Motley Fool says that Roku is currently a cash machine and generating a very solid stream of cash flow, and its user base is growing by leaps and bounds. It seems like it's a buy, but there's mixed reviews. So, Jim, two questions. Is it currently a buy, and will it be bought out by Netflix?
Well, I don't think it'll be bought out by Netflix, and we don't speculate on takeouts here. A cash machine, no. I mean, they are lucky to make money next year. If they do, they're going to lose money this year. We don't recommend stocks that lose money on Mad Money. It's just too hard. Let's go to Mike in Louisiana. Mike.
Hey, Jim. This is Mike from Shreveport, longtime viewer.
Thank you, Mike. Thank you. Okay.
Thanks for all you do for us individual investors.
Oh, I appreciate it. It's not an easy market, so I really appreciate those words. Thank you.
Well, Jim, I'm going to start a position in one of the three major defense contractors. I'm looking at them all, and all three are relatively equal with regard to price to sales, PE, leverage, free cash flow, etc. As it stands, I'm focused on Lockheed Martin. Jim, what's your take?
I think Lockheed Martin is a terrific stock. You know, we're going to have to do something with Ukraine, or the Russians will win. We're now getting that feeling. They're starting to use the same They're using a Chechnya playbook from Putin, 1999, 2000 now, just wipe out everybody. And unfortunately, it is working. Lockheed Martin offers the possibility that we can give them the weapons we need. Jim Takelett is the CEO. We've been on the show a number of times. That is a very good stock. Inexpensive, great cash flow, good dividend. There, it can be done. All right, Powell needs to tighten aggressively at this point, if only just to say we mean business, whatever business that might be. Oh, man, tonight, this is a tough, horrendous, unforgiving market, especially when it comes to stock discovery. So I'm screening the S&P 500 to see if we can find some high-yielding and high-growth names like we did in 2008. That's what we did. In 2011, we did it. In 2015, we're doing it, and now we're doing it now. Then if this market, you can't afford to make emotional decisions. So I'm turning to the technicals to see what the future could hold for the S&P 500. It's a little dicey. And could Indie Semiconductor be a SPAC that bucks the bad news trend? I'm talking to the company's top brass, and I know you've asked many questions about them. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.